The single most important number on this planet is US non-farm payrolls. This measures the rate of change of US employment. That in turn drives US equity markets, but also bond markets and central bank policy, and that has repercussions throughout the world, given the size of the US economy. So if you don't know what it is and you want to understand more, then here we go. Here's a definition of non-farm payrolls. The critical thing is that it captures 80% of the workers who contribute to US growth. As its name suggests, it excludes farm employees, but also other categories such as unincorporated self-employed people. This is what total non-farm payroll since 1940 looks like. It's just about to approach 150 million, but nobody looks at the absolute number. Instead, they look at the monthly change. Now, the vertical grey bars are recessions in the United States, and you can see with a recession, non-farm payrolls drops. That's because more people become unemployed. And while the unemployment number is a lagging indicator, in other words, it doesn't give you a forward-looking indicator of growth, the rate of change, which is what we're looking at here, is a coincident indicator. So it provides a great snapshot of what's going on right now with the US economy. But this is the US. Why should we care? We all know that the US economy is very large, but what's shocking is the size of the US equity markets relative to the rest of the world. Here are the rankings, and you'll see in the fifth column from the left is market capitalization. That's the size of the market in billions of US dollars. And the US market is disproportionately large. In fact, US shares make up about a third of the global $69 trillion market. In case you weren't shocked, here's the same information represented graphically. So how come payrolls is so important? Well, if payrolls are rising, that probably means that businesses are hiring. And if they're hiring, that probably means they're growing. And all those newly employed people have got an increased disposable income. And earnings growth for individuals means earnings growth for corporates. So rising payrolls paint a very good picture for the US economy. But you have to be careful, because if it rises too fast, that can lead to runaway inflation, which is generally a bad thing for risk assets. Now, every single institutional investor, that's pension funds, insurance companies, hedge funds, they'll be watching this Friday payrolls number and markets will respond. If the payrolls number is strong, equity rallies, people expect interest rates and inflation to go up. That in turn drives up the value of the dollar versus other currencies. And if interest rates go up, then the price of government bonds goes down, so this is bad news for the government bond market. And the mortal enemy of gold is high interest rates, so a good payrolls number is generally bad for gold. The place to look for the number is on the Bureau of Labor Statistics website. That's bls.gov, and they publish this data on the first Friday of every month. Don't be put off by the format of the report. It's the most boring presentation you'll ever find. But if you read through the report, you'll find treasure. The report contains data from two different surveys. Household survey data, which breaks down unemployment by race, by long-term unemployed and short-term unemployed, marginally attached workers, and discouraged workers. But we're going to concentrate on the establishment survey, which will break down quickly into 4 parts. Firstly, let's look at the headline. That's the monthly change in non-farm payrolls. You can see in January 2017, employment rose by 227,000. To illustrate what the important parts of this number are, let's look at this FT article from 2016, when non-farm payrolls rose by 242k. You'll notice people always talk about expectations. If people were expecting 230k and the number comes out at 242, then markets will be positively surprised, and the impact of that number will be greater. If it's below expectations, you'll get the opposite. So you always have to know what the expectations are before the survey's published. Another key thing is that the previous surveys are revised. So you may see the previous month's number increase by 30,000, which in this case meant a retrospective positive surprise because it was revised upwards. But of course, it's not just how many people are employed, it's also their average hourly earnings that matter. And this report was a little bit disappointing because the average hourly earnings fell. And the article also highlights the fact that labour market dynamics are the most important driver of US consumer spending, which is the main growth engine for the US economy as a whole. If you invest in single stocks, then you'll be very interested in the next section of the report, which breaks down the numbers by sector. So there's retail trade, construction, financial activities, and other major industries. Then we have the section with the average work week. That's the number of hours each employee worked on average per week. And we're looking here for an increase in the average work week. And another key statistic is the average hourly earnings. And again, we're looking for an increase in the hourly earnings because that would be seen as being positive. In the last section, you see the revisions in data from previous months. And that can hold positive or negative surprises, so always look at the bottom of the document. And then finally, at the bottom you see the date and time of the next report. Do you agree with us? Do you think non-farm payrolls is the most important number on the planet? We'd love to know. Tweet us at PensionCraft, message us on Facebook, and if you like these videos, subscribe to our channel.